I have to say, first question for you, Hugh, is just how much better these numbers could have been if we didn't have some of the supply side issues. How much better could this have been?
Boy, that's a great question, and nice to be with you all this morning. They clearly could have been better. We were certainly somewhat constrained on the supply side. I think generally speaking, we are more resilient than most in that regard, but I do think we probably did leave a little bit on the table as a result of some of the input challenges that we had. That said, we feel great about the quarter. I mean, 9% revenue growth is a strong number, and that's a sequential improvement on both a 1- and a 2-year basis. And in addition to that, very broad-based. Snacks were up 8%, beverages up 10%, U.S. up 6%, international up 14%. Developing and emerging markets were up 19%, so very, very broad-based growth, which we obviously feel terrific about.
Hugh, we saw this movie play out in a different industry a couple of weeks back. It was Nike. Great demand, problems with supply. You said something interesting there, that maybe you're more resilient than some. Where are you finding that resiliency at the moment, Hugh?
Well, I think because of the fact that we own our supply chain all the way to the shelf, we actually can adjust more rapidly than most. And that's been something that I think has been a benefit for us. In addition to that, in a labor market that's obviously broadly challenging, we're generally viewed as a good employer, you know, good pay, good benefits. So from that perspective, I think our supply chain and sales teams have done a terrific job dealing with what's been a lot of challenges. From a supplier input standpoint, we've clearly had some challenges on some beverage packages, and we're getting that stuff fixed. I expect as we exit the year, we'll be in a much better place in that regard. But because of our high level of supply chain control, I think we generally can manage this stuff better than most.
Hugh, help me understand the cost side of things, just on commodities as well. You mentioned labor costs too. Do you see these issues spilling into a new year? You mentioned supply chain resilience would persist through the next year as well. But just in terms of costs, commodities, labor costs as well, is that something you think will fade or something that will stay with us through next year?
No, I think it's going to be with us and well into next year at this point. And I've been of that point of view for a good period of time as well. You know, this question around transitory is all a question of definition on how long is transitory.
Yeah.
But I think given what's happening out in the economy right now, just the demand levels being as high as they are, I think we're gonna have some inflation for a while. And frankly, compared to what would otherwise be poor economic growth, I think inflation is probably the favorable problem to have at this point.
Hugh, what I'm trying to work out sitting here every single day is whether these higher prices hurt demand or whether we can continue pushing them on through consumers. When you look at things right now, do you sense some continued consumer price tolerance here? The ability to take on those extra prices, higher prices?
I do. The consumer balance sheets are generally pretty healthy these days. So from that perspective, I think there's a capability for consumers in a variety of markets to handle some level of price increase. In addition to that, I think consumers, because of it happening across a variety of categories, they're to some degree conditioned on it. And as a result, the elasticities are relatively low compared to, I think, what we would typically see in that regard. And then combine it with the fact that we're still a relatively low price, relatively convenient purchase. I think to the degree the consumer winds up feeling some stress, it'll hit durables long before it hits us.
Hugh, would you think about putting prices up again next year then?
We likely will see a little bit more pricing in the first quarter of next year as we really finalize the commodity outlook and we finalize what our cost inputs look like. So we'll get most of it done here in the fourth quarter, and then I expect we'll see a bit more in the first quarter as well.
Is this across the whole product lineup, or more specifically in different parts of the product mix? Hugh, how do you think about that at the moment?
Yeah, it's pretty broad-based at this point because the costs are hitting every one of the products. So we try to some degree at least match those up financially.
Hugh, just quickly, notice the regional pickup in LATAM. This reopening just really hasn't been synchronized at all this year. Are you expecting that to continue from America to LATAM and parts of Asia too? How does that work in your mind?
Yeah, I mean, obviously with individual countries at certain times, they need to shut down when COVID becomes a significant flare-up in their market. And there's a couple of countries in Asia that are certainly going through that right now. Vietnam comes to mind in particular. But broadly, I think, the economies and the people living in those countries are learning to adapt and manage their way through the COVID challenges. And with that comes mobility, and with mobility generally comes higher sales for our products.
Hugh, the other change I just wanted to touch on as well, you and I have touched on this a few times over the last 12, 18 months now. Clearly, there's been a transition in the way people consume your goods, away from eating breakfast at home, maybe getting back into the office. How's that transition developing as far as you're concerned, Hugh, and the stay-at-home consumption of, say, Quaker Oats? Do you think that's stabilizing now?
Yeah, it's funny. While people are getting more mobile and during the day, their habits are much more out of the home, and we saw it in our numbers. I'll use a U.S. example. Our out-of-home growth was about 30%. So it's taken us almost all the way back to where we were in 2019 in terms of its portion of our business. The one thing that seems a little bit stickier is breakfast at home. I think perhaps in a lot of ways, people generally like to eat healthier early in the day. Oatmeal is a terrific part of a healthy breakfast, and I think that's a habit that looks like it's going to stick for a period of time, even as people start to slowly but surely work their way back to the office. We still see good growth in oatmeal.
You're super constructive. It's a beat and a raise from PepsiCo this morning. You see continued price tolerance, consumer price tolerance. That's encouraging as cost pressure could persist into next year. Yet the stock's basically flat on the morning. Now, I know it's a frustrating question to answer, but you speak to earnings investors. Every single day you get earnings. Are you sensing that your message is resonating with them at the moment?
Oh, I think it is very much. I think investors have come to have very high expectations for our performance, and thankfully we're meeting those expectations. I'm not sure where we sit right now. The last I checked, we were probably up about 1%, and that's probably a reflection of the fact that we had a great quarter and investors expected us to have a great quarter.